Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why fast food chain McDonald's experienced its first sales drop in 4 years.
Plus, plane maker Boeing has a new CEO. We'll discuss that in the company's second quarter earnings.
But first, we will begin with the big tech earnings and Microsoft. Microsoft reported fourth quarter earnings and revenue that topped analyst expectations.
But the company's Azure cloud computing service posted a slowdown in growth last quarter, and this comes as investors are anxious to see a payoff from huge investments in AI products.
For more, we were joined by Anurag Rana, Bloomberg Intelligence Technology Analyst.
We first asked Anurag for his key takeaways from Microsoft's results.
When Microsoft gave guidance for Azure last quarter, they said growth rate of 30 to 31% in constant currency. And boy, they didn't hit 31, they hit 30. People got disappointed, but they did a good job of explaining what's happening on the conference call. At the end of the day, they are adding more capacity for their data centers, and the growth rate of the cloud still very strong. Will slow down slightly because of capacity issues and not demand issues. And as they get more data centers up, growth will accelerate.
Oh, okay. So to be clear, then they're saying, look, it's on us to build out all this stuff, and then all of a sudden the revenue will accelerate. This is not like a trend of slowing cloud revenue growth because of demand, just to clarify for me.
Yes, absolutely. In fact, and the cloud growth is driven in part, or I would say largely, by AI workloads because of their relationship with OpenAI. That really is the biggest driving factor. And Microsoft has an edge there over others because of that unique relationship that I mentioned. So I think Microsoft remains the primary beneficiary on the software side, similar to what Nvidia has on the chip side.
So, Anurag, part of the discussion, I guess, probably over the last month and a half about AI has been, okay, I understand the spending aspect of it to build out capacity, build out, whatever I need. Remind me once again, what's the return on that investment? So there's been some questions about the returns. How do you answer that question?
So, if you are in the semiconductor world, your return is pretty quickly because the people are going to buy chips immediately. But if you're in the software world, first you're going to get those chips, create a data center, add more servers, and then create your software products, that which you're going to sell. Now, that thing's going to take time, whether it's going to take 6 months, 12 months, 2 years, and then you're going to realize that AI revenue. And that's where the entire rest of the world is, whether it's on the software side or the services side. And people need to have a very good understanding of it. Otherwise, they keep on harping on this CapEx issue, which is going to get much bigger, and which is why the chip stocks are doing very well, because Microsoft communicated that they're going to increase their CapEx even more this year. So this is really where people need to understand this, and otherwise this confusion is going to continue going into next quarter as well.
Well, then, to that point, we got AMD boosting its sales forecast for AI. At the same time, Intel is cutting thousands of jobs. Where is Intel in this party?
Yeah, I think the biggest party player really is Nvidia with their GPUs that are truly required for these workloads, and AMD is also benefiting a little bit from that. Intel, I think, is needs to do a lot more work before they can capitalize on this particular trend.
So Intel's in like the quad, like not even close to coming into the frat house, basically. If we look at it that way.
Yeah, exactly.
How else in your space, Anurag? What else looks attractive here?
I think the fun is going to be tomorrow evening when Amazon reports and they start talking about their AI strategy, because remember, they do not have a relationship with OpenAI, but they are still the largest cloud infrastructure vendor and have more services than anybody else. They will come out and give the message that, listen, it's not just OpenAI, but other large language models as well that people are using, and they're using AWS services for that. Whether that's Anthropic or whether that's Meta, all these companies have their models as well, and people should be trying that.
And before I let you go, what I also found interesting was that 8 percentage points of the increase in Azure revenue and cloud revenue was attributable to AI. That was up about 7 percentage points. How do you think that winds up looking like? Like, are we going to start to see like double-digit increases here, or is it going to be a slow grind higher?
No, I think over time it will be double digits, but again, the timing is difficult. When we extrapolated this number, we are coming to somewhere around 1.4 billion in this quarter. That's over 10 times in just 1 year. It was, it was roughly around 100 plus million a year ago. This is all the AI workloads from OpenAI. So, I mean, it is really a big number, frankly. But over time, what will also happen is there's going to be a blending between the workloads on AI and the non-AI workloads. And for us, the net beneficiary are the three biggest cloud vendors. And in fact, even Oracle is going to benefit from this.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst.
We now take a look at the latest Bloomberg News Morning Consult poll.
It shows that Kamala Harris has wiped out Donald Trump's lead across 7 battleground states as the vice president rides a wave of enthusiasm among young, black, and Hispanic voters.
For more, we are joined by Laura Davison, a Bloomberg Politics Editor.
We first asked her for her key takeaways from this poll.
This is the best that the Democratic challenger to Trump has ever done. This is the first time we have polled Harris. It's a statistical tie, essentially, between the two candidates. She's technically up 1 percentage point, but that's within the margin of error. The other key takeaway here is that black voters, young voters, Hispanic voters are much more likely to vote now that Harris is on the ticket. So this has been something that the Trump campaign has created their strategy around, of trying to get pull away at the margins some black voters, some Hispanic support. But this would indicate that perhaps the tides are shifting in Harris's favor on that front.
Well, that was sort of one of my questions, too. Are these voters that are switching, or are they new voters that are swinging these polls?
So we don't yet know totally what that is based on how the poll works, but what we see is that voters who are unsure if they're going to vote are now saying they're much more likely that they're going to vote. So these may be people who voted in 20, who were not enthused by either candidate, who are going to stay at home, or people who maybe have never voted. But, a turnout election is expected to help Harris on this front versus Trump. The Trump folks were, sort of hoping to pull away particularly black men, Hispanic men, but, we're not hoping to see a big surge in turnout that really helped Biden in 2020 and could potentially help Harris in 24.
Laura, as a former Wall Street person, I tend to follow the money, and Vice President Kamala Harris has had a pretty good run here in the last week or so raising money. Do we know where that money's coming from?
Yeah, so her campaign says they've raised about $200 million, and that's in the first week or so of the campaign. This is largely from small dollar donors. These are people who are going and giving online, and increments of anywhere from just a couple dollars to up to a couple $1,000s. We've also know that her super PAC, this is the group that can accept money in unlimited amounts, has gotten $150 million in commitments since Biden has dropped out of the race. These big dollar donors, people who give millions of dollars, had decided to withhold a bunch of contributions, in order to sort of pressure Biden to get off of the ticket. So now that money is coming back into the fore. Just for, kind of some comparison here of Harris, when she inherited the Biden campaign accounts, it had about $100 million. Since then, she's raised another $200 million. So these are really big sums.
How much of this could be also attributed just to momentum? As in, when you have the RNC, the candidate gets a boost. The DNC provides a boost. This is an unprecedented moment in political history, so no doubt the candidate would get a boost.
Yes, and the timing here is all really interesting because, of course, Biden just dropped out 2 days after the RNC. So Trump was expecting to see a big polling boost coming out of that. Of course, just a week prior, that had been the assassination attempt. Leaving the RNC, Republicans were very confident about their chances. And, even Republican operatives were saying one of the things they needed to be cautious of is that they weren't overconfident. Of course, that all switched, just a couple days later. What the Trump team is saying is, look, this is a Harris honeymoon. This is a surge in momentum that will just be a flash in the pan and won't last until November. That's really what we'll be looking for in the next couple weeks of, is she able to maintain both this fundraising edge as well as this polling edge, or do we revert to where, the Biden-Trump race was just with Harris on the ticket in a couple weeks?
What do we make about the situation in Israel and how that is polling for Kamala Harris? Because clearly there is a huge section of voters that is very unhappy about what's happening in Gaza, right? That we're maybe not voting at all for President Biden. But are they coming back in now? Do we know anything along those lines?
Yeah, so what this poll shows is that people who are very concerned about the Israel-Gaza war, and particularly young voters for whom this is a bigger issue, are more likely to vote for Harris. She's taken a softer tone on this and is, just doesn't have quite the same negatives on this issue that Biden does. One of the things, particularly just with the, events of late of, kind of there being more unrest in the Middle East, is, the Biden administration is still pushing for a ceasefire. Harris is still pushing for a ceasefire. Democrats really want this to be an issue that is working towards a resolution versus, an issue that's flaring up, particularly as students go back to college campuses in a couple weeks. They don't want to see the protests that we saw last spring.
Do the Republicans have buyer's remorse for J.D. Vance? I'm seeing some reporting along those lines.
Question.
Yes, there's a lot of conversations on that. Even on a Bloomberg television, Mick Mulvaney, who's a Trump ally, came on earlier this week and said, no, they're not looking to replace J.D. Vance. But of course, if you're being asked about this means that this is at least a conversation that is circulating. Vance has had a rough rollout, just in about the, 2 weeks or so that he's been on the ticket. Some past comments he's made, sort of degrading childless cat ladies have come up. He has had some jokes on the campaign trail that have come across as crass and haven't really landed. So this is a conversation that's happening on upon the sort of Republican, elite, the mainstream Republican class, but isn't really reaching the Trump campaign. They have continued to say JD is our guy, and we're going to stick by him.
Our thanks to Laura Davison, Bloomberg Politics Editor.
Coming up, we're going to break down why wireless carrier T-Mobile added more subscribers last quarter.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to the aerospace industry and Boeing. This week, Boeing announced it's appointing Kelly Ortberg as its next CEO, replacing Dave Calhoun.
Boeing made the announcement as it reported burning through more than $4 billion in cash last quarter. For more on all this, we were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We first asked George if its new CEO is the guy that Boeing needs to turn things around.
Not so sure. I think it's the guy that Boeing needs for a small period of time, right? Because he was already retired, right? He has he's a great career in aerospace, working at Collins, helping put Collins into RTX. I mean, great experience. He's 64. So my guess is he doesn't have a lot of runway to work at Boeing. I think it would have been nicer to see a CEO that could have put, 5, 7, 10 years into Boeing. But look, I think the job is very difficult. And so I think it's going to take a lot out of the next CEO. And so maybe this is an interim as they continue to develop internal candidates for the job. Maybe it's pretty difficult to recruit somebody into this job right now, so could be an interim because of that as well. So again, the strong aerospace background at the component, at the parts maker level, but doesn't look like someone's going to be around for the next 5, 7 years.
All right, George. All right, so that's the CEO. How about on the fundamentals here? I'm looking at the second quarter, negative adjusted free cash flow, $4.3 billion. You can't
good.
Like that. Talk to us about kind of the cash flow, the dynamics, and what they need to do.
So we kind of expected that $4.3 billion. To be really honest, not totally sure why the stock is up. I don't think it's Kelly, because Kelly news started the day out, and Boeing, I think, was up about 1. So post earnings were up. We've done this pop. We heard from CFO Brian West during the call. He told us burn was going to be pretty strong in 3Q2. And then the analysts tried to box him in on what burn was going to be for the year. One said would be closer to $5 billion or $10 billion. He said he wasn't. I think his quote was something like, "I'm not smart enough to tell you at this time." So there's just a lot of variability right now. Look, Boeing has to keep taking inventory, taking ship sets from their supplier base to keep their supplier base in business while they ramp up builds. And they had some good commentaries and builds. They talked about the factory kind of putting out 20-ish, I think was the number. And I think total deliveries in the 30-ish range for 737s, rising to 38, shutting down those shadow factories. It's the factories that they have the inventoried airplanes, a lot of 737s, some 787s, and shutting them down by the end of the year. That was, I think, great commentary. We got to the commentary about what's going to go on with the union negotiations. Those are coming up in September. Dave Calhoun kind of told us he, I think, wasn't totally focused on that right now, or couldn't give us puts and takes there. That's incredibly important, right? So if we get into a situation where the union shuts this company down in September, the cash burn this year looks horrible. They're back going to capital markets, looking for a bond raise, which I think everybody on the bond side is scared to death about because they don't want to see a fall to investment grade, or they're going to the equity side, which the equity guys don't want to hear about, right? Because that's dilution. So I think, again, commentary was good around deliveries and things like that, but a lot of variability coming, here around this cash flow burn, and it's super important.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We move next to earnings from Trane Technologies, the maker of heating and cooling systems. And the company posted better than expected earnings in the second quarter and raised its full-year forecast.
For more, we're joined by Trane's CEO, Dave Regnery. We first asked David why the company had such positive results.
As far as what's driving our growth, I always tell people we have a system of things that makes Trane Technologies a great company. And whether it's the way we operate our facilities through our business operating system, whether it's the way we innovate our new products, or whether it's our direct sales force, those are a system of things that make us a great company. And we have a service business that's a third of our company that's performing extremely well. In the second quarter, our service business was up mid-teens from a growth perspective. And we have a culture that's, we believe in challenging what's possible and innovating for a sustainable world.
So based on that, it's great to chat with you, by the way. I love talking to you because you have such a great read on the residential and commercial businesses. Basically, you have a commercial HVAC unit and a near-term residential HVAC unit. And of course, that's heating, ventilation, air, and cooling. Where's the strength? Where's the growth? Where are the weak points?
Yeah, I'll start with residential. We had a very strong quarter in the second quarter. Our revenue was up low teens. But our residential business for the prior, I'll say, 3 quarters had really been struggling with a refrigerant change that wasn't clear. That's been clarified. It was really struggling with excess inventory, kind of a hangover from the COVID days that was in the channel. Those both corrected, and we're off to a very warm start to the cooling season, which should have us all concerned for a different reason as the climate continues to increase in temperature. But I would tell you that it's a very strong start to the year. So very strong in residential. Our commercial business, really broad-based growth. Certainly the high growth verticals like data centers, we do very, very well in, or education, or in healthcare. But we had broad-based growth. In the Americas, we track 14 different verticals, and we were hard pressed to find a vertical that we were not strong in. So it was a very strong quarter for Trane Technologies. I'm very proud of what the team's been able to accomplish.
Yeah, I'm reading the Bloomberg Intelligence research note out on your earnings. North America's 16% organic growth was much greater than the 10% consensus. What drove that?
Yeah, really 2 things. Our residential business performed better. Okay, we thought that was going to be, in the beginning of the year, we thought our residential business would be low single digits. We came in, low teens in the quarter, so we significantly outdrove that. And then our commercial HVAC business just continues to operate at a very high level. And like I said, services was up in the high teens, actually, in the Americas, and their equipment business just continues to exceed our customers' expectations. So very strong quarter. I was listening to your show earlier. You were talking about sustainability, and I would tell you that at Trane Technologies, our purpose is built around sustainability. And what people are talking about right now is you're hearing a lot about, how much power is going to have to be generated to meet the demand that's coming. And you'll hear a lot about data centers using a lot of the electricity. What nobody is talking about is the amount of power that's being generated that's being wasted. And I would tell you, we call it demand side management. And we know, because we've done hundreds of thousands of energy audits in buildings, that most buildings operate about 30% inefficiently. So just think if we could solve that problem. And if we can make buildings perform the way they were designed, or assets perform the way they're designed, just think about the amount that we could save in the energy that's being produced, and which obviously has a trickle effect to the carbon footprint. So that's what Trane Technologies is all about. People always ask me, where do you see the growth coming from? It's going to be on the demand side management side.
Our thanks to Trane Technologies CEO Dave Regnery.
We move next to earnings from the wireless carrier T-Mobile. The company reported new monthly mobile phone subscribers that exceeded analyst estimates.
For more on this, we were joined by John Butler, Bloomberg Intelligence Senior Telecom Analyst. And we first asked John why T-Mobile did have such a successful quarter.
You know, it just boils down to this. They lead in 5G. And for any wireless carrier, the lifeblood of the network, the speed of the network, the download speeds that you get on your phone is dictated by how much spectrum you own. In plain English, how fat are your airwaves? And the great news for T-Mobile is they have the most spectrum of any of their competitors, and they have the right amount of spectrum for 5G, and we're now seeing it translate into better results.
And I'll note that our own Charlie Pellet is a very happy T-Mobile customer. Oh, you
I'm
too as well?
I'm T-Mo.
Okay, very good. I didn't really know any. You're probably the only two I know, which says something about the circles I run in. John Butler, so is this just a share game, John? I mean, everybody's got a cell phone, so is this just a share game between AT&T, Verizon, and T-Mo?
It is, Paul. You know, it's really, in a way, become a zero-sum game in some ways. There's natural organic growth as, you know, young kids get phones, older people have been getting phones post-pandemic here. I think that really shook up enough of the market to lead to that little bit of growth on the edges. But the bottom line is it's a very slow growth market. And so it's all about not only protecting your share, but taking it away from your competitors. And T-Mobile has, you know, people forget that really wireless is almost a retailing game, right? So it's all about branding, and T-Mobile has done a brilliant job manufacturing a brand image that's all about being consumer friendly and low prices. And so quarter in and quarter out, they tend to lead their peers, AT&T and Verizon, in terms of net new subscriber growth. And this quarter, in my mind, they really hit the ball out of the park on that front.
At some point, will I also get my internet from T-Mobile? Like, is this the next area that they can just start gobbling up share?
Possibly. Actually, if you live in New York, I would say a definite maybe. They've been very cautious in terms of managing expectations for where their broadband business is going to go, but T-Mobile offers both over-the-air broadband called fixed wireless access. You basically put a modem in your window, it talks to the wireless network and provides you broadband that way. It's a real set it and forget it thing. It's been a major hit with consumers. Verizon is also a major player there, but T-Mobile is also getting into fiber broadband. And when you think the future of broadband and where it's headed, it really is going to come down to fiber in the long run. So I think they're placing the right bets. They're moving ahead with fixed wireless access for now because they have excess capacity on the network, but they're reluctant to really ramp up expectations there because broadband eats up a lot of that spectrum we were talking about on the network. So they don't want to endanger their core wireless mobile business by rolling out too much in the way of broadband over the air. But I think fiber hedges their bets there. And by the way, they over-index in New York. They really have great share in New York in mobile. So I think broadband is their next foray for that market.
Our thanks to John Butler, Bloomberg Intelligence Senior Telecom Analyst.
Coming up on the program, a look at quarterly earnings from Heineken.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the fast food chain McDonald's. This week, the burger chain said it experienced its first sales drop in 4 years when it reported second quarter results.
This comes as the company has pledged to launch new promotions to help offset a decline in customer visits. And this includes a $5 value meal deal launched in the final week of last quarter.
For more on all of this, we are joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst.
We first asked Michael for his key takeaways from McDonald's earnings.
The biggest takeaway is that they still have work to do. I guess results weren't as bad as expected. July data that we've seen is pretty bad. So the fact that they're still negative isn't really surprising, but they definitely still have work to do. The $5 meal deal seems to be bringing in some traffic. They're hopeful that, the sales will follow, but it hasn't happened yet. And they talked about the U.S. really needing a revamp of its $1, $2, $3 value meal. This company has scale that nobody else does. They can offer price points that nobody else can. They have a ton of marketing might. So for those reasons, in this really competitive market where chains are fighting hard to attract low-income consumers, McDonald's definitely has the tools to win.
For me, the McDonald's experience was always an airport experience, because I could always say, I could justify it by saying, hey, I'm rushed for time, I got to make my flight, get something quick. But now all the new airports and like the renovated Newark airport, there's no fast food in those things anymore. You have to sit down and order and do all that kind of stuff. So that's why I haven't.
That's interesting. But isn't there fast food, but it's like nice stuff, like wraps
Well,
and
yeah, you
salads.
get that stuff to go. But I mean, you could always get like some fast food, serious fast food. All right, so Mike, what's the story for McDonald's here? Do they open stores? Do they rationalize their footprint? What's kind of the strategy there in terms of managing their footprint these days?
Yeah, well, they're in their investor day late last year, they pushed for more aggressive store openings, right? And so that's going to continue to be the focus. They're going to push hard to grow internationally. China obviously is a big point of focus for them. But yeah, it's going to be to open stores. But in order to motivate their franchisees to open stores, they're going to have to, have a strong marketing program that's going to pull people into the restaurants, the existing restaurants, grow same-store sales, improve profitability, and make it just a more attractive proposition for their international and U.S. franchisees to open new stores.
Didn't they unveil like a $5 meal thingy? But that was at the end of the quarter, right? So we don't really know the full impact of that for McDonald's?
Yes. So on the call, management said that it's driving traffic, but not sales yet. So it seems like there's some trade down from current customers saying, well, $5, I get a lot of food for that $5. So maybe instead of getting a Big Mac meal, I'll get this $5 meal deal. But so it hasn't really impacted results yet, but they said that, historically traffic comes before the sales boost. And so they seem positive on it in this near term. They said 93% of franchisees in the U.S. have agreed to extend this offer deeper into the summer. So they seem positive on it, but their real focus is going to have to be on the $1, $2, $3 value menu. That menu isn't resonating with customers, right? And it seems like a full revamp is in the cards. They've received a lot of shade on social media that you can't find anything on that menu for $1. Right. And so some re-engineering is going to be necessary here in the United States.
All right. Dumb question of the day comes from me.
Never.
At McDonald's, Burger King, even Starbucks, the drive-thru line, they're like 20 cars deep. I walk inside, I walk right up to the counter, and boom, I'm served. And if I'm a McDonald's, isn't that a source of opportunity for me to figure out how to get them through faster?
Yeah, well, I guess we're lazy. That's the problem, right? But no, to your point, a big percentage, historically the counter was like, say, 15% of a drive-through restaurant sales. And historically, that's really just been used when the drive-through line is too long. And people say, I don't want to wait that long. I'm going to go inside and pick up my stuff. So there is an opportunity. It's a point of focus for all of the quick service restaurants we cover. Everybody is constantly trying to improve their throughput, decrease the time waiting in line, because they know if there's, at a certain number of cars for McDonald's, historically, it's been, say 5 or 6 cars in the drive-through. People will either, drive past the restaurant, or maybe they'll say, I'll park and come in. But that's potentially business loss, right? So, improving throughput at the drive-through and at the counter is constantly a point.
Well, that's what I was going to say,
but
AI.
It hasn't been working, though.
I mean, in theory, right, you get like an IA thingy to do the drive-through, right? But that has been really tough to manage right now, right? It's not really the best.
It's not working. I mean, they're having a lot of trouble with accents, not only from, international customers, but also dialects across the United States. So voice ordering and a lot of these AI initiatives, there's a lot of potential with them, but they haven't been able to really pay dividends just yet.
All right, so what is the investment call here, Mike, for some of these fast service, McDonald's, Burger King? What's the investment call here for these names?
Well, they're looking at, it's interesting because the year-over-year comparisons, base effects get easier into the second half, but the consumer's weakening, right? And so, McDonald's said they expect, more consumer weakness over the next few quarters, right? And so there's definitely concern about restaurant spending here in the second half. I think I mentioned it at the top. McDonald's is well positioned, though, in periods of distress. During the Great Recession, they outperformed by offering value that competitors couldn't match, right? And so it's a very tough environment, but we think McDonald's is positioned pretty well for such a tough environment.
In the value war where everyone's chasing a smaller part of everyone's wallet, how do these guys remain profitable? I'm not just talking McDonald's, but like all its competitors too. Like it's sort of a race to the bottom to some perspective. How does that play out?
It's not just a race to the bottom. So in terms of the low end, they're trying hard to keep that low income consumer business, and there's no doubt that that's a big focus right now. But they're also bringing in middle income and higher income consumers into the fold, right? So you also get this traded down effect where, sure, low income consumers are trading down into grocery store, but McDonald's and some of their competitors, Jack in the Box being one, Chipotle, have been able to attract these higher income consumers that actually come in and buy premium items and spend more when they come. The problem is they're just a much lower percentage of the overall traffic. But that's what we've seen over the last year and a half or so, is chains that have been able to attract these higher income consumers are definitely outperforming.
So where in your overall space there, Mike, on the restaurant side, is the best place to be these days?
It's companies that provide a lot of value and a very good price point, right? And so, like most earnings seasons and industries, a lot of the top performers end up reporting earnings first. And we've seen that Chipotle and Texas Roadhouse are two. They outperform everybody on same-store sales over the last 5 years, and there's not even a close second. And a big reason why they've outperformed by so much is that customers see a lot of value on that plate for the price that they pay. Right, and they're provided a pretty good customer experience, and that's what's bringing people in the door. If you're providing very strong everyday value and a good in-restaurant experience, clean restaurants, good service, and everything that entails, then you're winning.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst.
We next take a look at earnings from the Dutch brewer Heineken. This week, the company reported quarterly profit and revenue that fell short of analyst expectations.
Heineken cited a $949 million hit as its stake in China's largest brewer has fallen in value. For more on this, we are joined by Duncan Fox, Bloomberg Intelligence Consumer Staples Analyst.
We first asked Duncan to take us through the laundry list of things that were a problem for Heineken.
Well, I suppose the main one was consumer sentiment is still quite weak. So what they were hoping for was a bit of a bounce back in Europe for volume with the Euro 2024. But unfortunately, the weather was just, again, poor in Northern Europe. So that was a hit. In China, it's just that China Resources beer share price has been below the price they bought it for about 4 or 5 months now. And the accounting system means they have to take that hit. So if that share price goes back up again whenever the Chinese economy recovers, then they'll get some sort of recovery from that, but I can't tell you when that will be. So it's just dull consumer.
So what is Heineken saying about just underlying demand in general? What are they saying about the consumer, and is there regional differences, I guess?
Basically, the consumer's been hit by inflation for the last 2 years, probably double-digit pricing, and I think they're just paring back. The big problem is that people are not really going to the pub as much, the on-trade. That's where they make great profit. Well, in Europe, it's certainly been the case. And in places like Africa, where you've had devaluation as well, you've just got to work your way through that. And they've done a very good job, actually, but you still have the short-term issue where, Nigeria is a big market for them, and you get a massive devaluation. And so they're just working their way through all these issues. They're doing actually quite a good job on the ground, but weather was the real thing that was a surprise. I mean, they upgraded guidance a little, But I think people are expecting a bit more because of the Euro 24.
So Paul brought up sort of those mixed infused cocktails and stuff. I can get a mimosa in a can. It's not terrible at all. Does Heineken have exposure to that kind of stuff? And is that sort of eroding the appeal of beer at all?
Well, beer's getting it from every angle, really, because you're seeing a lot of these new odd drinks. I'll probably agree with Paul on that one. Some of them are a bit weird, but they've got Desperado, which is a spirit-based beer, a tequila-based beer, which is doing very well. So they have got things that they can attack these products with, but you need to keep basically innovating with new things all the time. Diageo are doing a pretty good job on trying to do that, but the problem is some of these don't last very long, the 18 months, and then things sort of fall off a cliff. So you've got to sort of keep replacing them, otherwise you get into a bit of trouble. So actually the Heineken one's doing well, but they just haven't come up with innovation in that area. It's probably not their key area for them.
Is Heineken calling out different regions of the world behaving differently? Is the U.S. market stronger than the European market or Asia?
If you have a nice beach, your sales are up?
Exactly.
Well, certainly if the sun's out. They're not that big in the U.S. In Latin America, they're big, and they've taken quite a lot of costs out. They were importing bottles to Brazil, for instance, which is a huge market for them. So they've taken the cost down. So it's not particularly great consumer environment there, but the profits are improving because they've realigned their cost base. In Asia, they're bouncing back from a really horrid time last year where the economies, Vietnam in particular, had a terrible time in sort of Q2 and Q3 last year. So that's bouncing back. I wouldn't say the beer market, because of regulation, is buoyant, but they're gaining share, and they've done innovation on the beer market there that seems to be working very well. So there are a few issues in Asia that they've still got to overcome. China, it's quite a chunky bit of their market now, so they need to see that economy improve. Places like Cambodia have got a bit of an issue in the short term because of the economic growth. So it's just a case of good old policies from governments turning the economies around. Consumer get a bit happier with life, and people then go out and buy beer.
Our thanks to Duncan Fox, Bloomberg Intelligence Consumer Staples Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.